Hey everybody, Don Snyder here with Priority Home Lending. I want to take a quick minute to talk a bit about something that's been in headlines in a dramatic way over the last 10 days or so, and that is the federal funds rate. And give you a quick rundown right now of the difference between the federal funds rate and the mortgage interest rate, and how federal funds is not really a good indicator of what mortgage interest rates are going to do, but I will show you a much more reliable indicator. So let me share my screen here with you really quickly. Let's cut that down here. Okay, so let's look at Investopedia first, right? How do we define the federal funds rate? What is federal funds? And it says here the federal funds rate refers to the interest rate that banks charge other banks for lending to them excess cash from the reserves balance on an overnight basis. So simply put, federal funds rate is an overnight interest rate on loans between banks. So it has nothing to do with consumer lending or mortgage lending, which is really quite long term versus this very short term overnight basis. Now here's how we're going to look at the difference between them. We're going to go to the St. Louis Fed's economic database. Anybody can access this for free. You don't even have to log in. It's so simple. So the first thing we're going to look at is the 30-year fixed rate mortgage average in the United States. And this goes all the way back to 71, right? We can see the really dark times of 1981 where the average interest rate was 18.63. That's not fun for anyone. So we're living in great times here with rates in the threes, the mid to low threes. I'm gonna shorten up that time span there so we can get a better look. These dark columns, those are recessionary periods in the United States economy. So interesting to note that. Now what we're gonna do is we're gonna add on top of this graph some more information. And we're gonna call this line federal funds. And so we're choose the effective federal funds rate right there. And let's see what it looks like when we stack those on top of each other. Well, that's pretty interesting, isn't it? What we see here is over and over again, periods where there's divergence, where your federal funds rate comes further away from the line of your 30-year interest rate, and then they converge, right? And then they diverge again. And so there's some pretty significant dips here, right there and right there. And, you know, in general, they're heading more or less in the same direction. And that does illustrate the point that the Fed funds rate certainly affects the mortgage interest rate, but it's not a good indicator of exactly what's going to happen. So as promised, let me show you a much better indicator. We're going to get rid of the Fed funds there, and I'm going to add in a different line. Let's see here. And that line is going to be the 10-year Treasury. I'm going to add that data series right there on top of it. Interesting. We can see right off the bat that there's a much closer correlation. These lines actually move together very, very closely. And so that's why one thing that a lot of people in the mortgage industry know, a lot of people outside of the mortgage industry do not know, is that if you want to have a better idea of what's going to happen with rates, we want to look at the yield on the 10-year Treasury note. So it's a really good indicator actually. And these are, you know, sold both on the bond market. And so a lot of the same investors are going to be looking at the various factors here and deciding, you know, which one of these to purchase, and that's going to affect the yields, which is going to affect the interest rates. And so then just for clarity, we're going to add one more time the federal funds rates on top of that. And give you a little bit of comparison in the accuracy between federal funds and the 10-year Treasury. So we'll shorten that up so we can get a better look at it. And you see how right here, the green line is the effective federal funds, and that dips way below. Whereas we've got that 10-year Treasury hugging really tightly to the trend line on our 30-year fixed rate. Once again, here, humongous, oh, let's zoom back out. We don't want to get that close. Right, but again, here we've got a widening gap with the federal funds and a widening gap whereas all the way across, that 10-year treasury hugs it pretty closely. So that, my friends, is just a really quick explanation. I tried to keep it to 5 minutes. I almost succeeded, and hopefully that's going to give you a better idea of what to look for and what to expect when you're trying to anticipate what mortgage rates are going to be, whether that's for a purchase or for a refinance. Of course, if you have any questions, call me, text me, email me, leave a comment underneath this video. I don't care what it is. Just find a way to get a hold of me, because I would love to talk through this with you. It's one of my favorite parts of my job, is helping people understand the market and how that market is going to affect their mortgage rate and their long-term finances. So everybody have a fantastic day. Thanks for giving me your time, and I'll put out another video again soon.